The market's crashing. Should you buy the dip? People are asking me, Trav, are you buying the dip? And well, we're going to get into it. I'm going to look at the markets. I'm going to talk about system trading. We're going to talk about historical crashes and bear markets. And we're going to talk about fundamentals. But it's been a wild week in the market. This is the Japanese stock market. You can see with the daily chart, like 15% down. Obviously, there's a lot of conversation about the stock market in the US, where this week it's down about 12% from all-time high. It's now down about 17%, 18%, which is not quite a bear market. But I mean, the bear market definition is typically 20% from the top, which it's really arbitrary. The Nasdaq is greater than that. It had a really ugly week. And we see in all cases we're coming down to this August low down here. US 500 went under, or the July August low went under it. I want to talk about commodities. I want to look at the dollar. I want to talk about crypto. There's a lot of things I want to talk about. There's a lot of volatility on currency market. Bitcoin actually surprisingly had a green week. And the altcoin market also had a green week, which is really interesting. Actually, no, altcoins did not have a green week, but they didn't do that badly. But Bitcoin is showing a lot of relative strength. We also have gold that had been leading the market, finally had a correlation one day where it was big red along with the stock market. To me, I was expecting that eventually because at some point when margin calls come and there's a lot, people have to sell everything just to raise cash. So let's talk about am I buying the dip? So, and we're gonna look at our system here. Okay, I don't have premium trading view. I promise I'm not being cheap. Actually, I had my wallet stolen last week and I canceled all my cards and I got new cards and I haven't had a chance to pay for trading view premium, which doesn't really matter, but it means I only get two indicators. But all I want to put up right now is the 200 moving average. So I've been telling you guys for a very long time. I got a comment recently. I wish I listened. I've been telling you guys for a very long time. Now, I was calling for a major top in the stock market. But another thing I've been saying is, as a system, I'm a huge fan of having a 200 moving average filter. You do not buy under the 200 moving average. So, am I buying this dip? I'm not buying this dip. It might be the bottom, but I'm not buying it. But why? So, there's a couple scenarios. I mean, we look back in the last 5 years on this chart. The 2022 bear market was very choppy. It went down 26%. This has been a straight line down, 17%. It looks more like the COVID crash. Is it going to just V bottom to massive new highs? It's possible. I'm prepared for all possibilities. I'm going to talk about possibilities where it doesn't, though. Let's go into the weekly chart. Actually, I want to stay on the daily because I want the 200 moving average. Let's go to actually the S&P 500 on the daily. And let's look at, so it could be like the COVID crash where we go straight to new highs. That's a possibility. It could be like the 2008 crash where there's multiple major rallies. And how long did it take to recover from 2007? It took 6 years. It's possible. I'm gonna pull up the 2000 crash on the Nasdaq, and we're gonna look at the Nikkei 225, the Japanese market. But it's possible that we see something like this, where we have this massive decline that takes a long time to rebuild. A lot of you guys weren't trading in 2000. I wasn't trading in 2000, but I study it to make it back to about 5,000. It didn't revisit that high until 2016. It actually took 16 years to make a new high. So for those of you guys thinking, I'm just gonna buy here and average in and I'll be good. That might work. We might just go to new highs, but it's possible that price trades under this moving average for the next 2 years. That's why I'm more interested in, I want to buy, I would maybe take a loss here, but I'm looking for price to emerge over the moving average at some point. And that protects me from this scenario. It's not always about making money in the markets, but about preserving capital. In the case we get something like a COVID crash, I won't necessarily be that late to buy. So let's put on the system or one version of the system. There's a couple that I trade. This version of the system, if we look at the stock market, we got out and sold everything. This is where I sold everything, is in this area, mid-February to late February. And look, it's just flat. So people are asking what levels am I looking at? Well, I could show you levels, but they just don't matter. I'm prepared for this just because let's show untouched levels. Show untouched levels. So touched, recovered, cross levels, touched, show untouched levels. Let's do that. With 1 and 100. So we could look at these old levels down here. These are old key levels, old monthly lows. The issue is I found that age really matters. If you're buying a dip, you want it to be a level. If you're buying like, first of all, if you're buying a dip, you don't, and I say you don't, you shouldn't. This is what my computer back testing has found. And my computer back testing is pretty robust. We're talking looking at gold for 100 years, looking at the various US stock markets for 100 years, looking at Bitcoin for its entire price history. You don't just want to buy red. You want to wait for it to take, if you want to dip buy, wait for it to take out a key level and then wait for it to reclaim that level. I'll say it again, wait for it to take out a key level and wait for it to reclaim that level. And what I've found out is it's better if that level is at least 15 days old, but not more than 90 days on average. So we're taking levels right now that are over 100 days old. So I'm not interested in trading them. One, they haven't reclaimed them. Two, they're too old. So what would I be looking at to take a trade is one, let's have the moving average. Say the moving average does this, and then price does this. Still not a buy yet. And then it takes out this key level and price is above the moving average, and then I'm adding here. That's how the system trades. So all my money is in high interest savings right now. It would take me a couple days to a week to transfer any substantial capital to take a stab and buy this. But it's too early for me. I'm just not interested in trying to buy bottoms. Now, if you are a jobby and you have a high income and a low expense and you have more money coming, dollar cost averaging here is probably fine. But that's just not my strategy and what I'm planning on. Now I want to show you guys something that a lot of you probably aren't prepared for. But this is the Japanese stock market, and it topped in 1990, and it didn't make a new all-time high until 2024. So it was actually a 34-year bear market. And I'm not saying that this has to happen, but I'm saying that it definitely can happen. It's a probability. And we have some similar demographics. One is aging population. So one of the issues is that a lot of the demand on stock market that causes pressure to go higher has been from boomers. And those boomers are beginning to sell out because they are living off their retirement. In the US, we're seeing the possibility of a older population that's net selling. We're not seeing a lot of kids being born. and people are feeling poorer. So there's this possibility that there's a major demographic shift that causes something like the Japanese stock market. Again, I'm not predicting it. A lot of you guys get this twisted and you're like, that could never happen. It just could. Why not entertain a number of possibilities and be prepared for them? So what do you do in this you have to look at other assets, emerging assets. You trade gold, you trade the US stock market, you trade crypto. It's been the US stock market. It might not be. It's been Bitcoin. It might not be. It's been gold. It might not be. You have to pay attention and look, what is the next asset going to be? So we're going to look at a couple things. We're going to look at commodities and we're going to look at crypto. But before I do that, I want to go back for a minute and look at the March 2020. So it's a possibility that we get a March 2020 case. I'm going to talk about what that would look like. I think it's unlikely, but again, I want to be prepared for a number of possibilities. So the COVID crash was caused by the realization that there was going to be some kind of unknown disruption to the supply chain. And this crash is caused by tariffs. Now, which is causing an unknown effect to the supply chain. Now, I want to say in this case and in both cases, a similarity between 2025 and 2022 is what? Is there was a high amount of leverage, financial excess. So this was going to happen. It could have looked like choppy or it could have looked like straight down, but it's happening because of tariffs is a trigger, is all it is. So if the economy is strong underneath this, but if there wasn't this high amount of financial excess, the tariffs might not have triggered it to the same extent. Now, from a fundamental perspective, the market is crashing because the cost of doing international trade is going to raise by at least 10% almost overnight. A lot of businesses are going to fold. This is a COVID level effect. Now, there's a lot of uncertainty around this where Trump says he's willing to negotiate. He's trying to cause a crisis and step in and do something with it. That seems to be what it is. So he can negotiate a deal and the markets just recover. That said, to me, that's unlikely because even if he negotiates a deal, there's so much uncertainty now. There's such a wild card. And you also have this underlying financial excess that might need to be cleaned out. So to me, immediately going to new highs is unlikely, but it's possible. One of the things that would cause it would be a lot of money printing. Now, the thing about the money printing is because inflation is already high and it's very unpopular, it's unlikely that a lot of stimulus would pass. I mean, if something breaks, which probably will, and they'll have to do it, perhaps. But Powell does not want to lower interest rates. They're not looking to cut rates to zero. They're realizing, I think a lot of people realize that COVID, the stimulus, a lot of it was a policy mistake that caused the inflation and they don't want to repeat that. So to me, I expect extreme volatility. I expect a really sharp move up, like bear market rallies. But do I expect that we're going to immediately go back to the status quo? Not necessarily. I think things have changed. Fundamentally, the demographics are changing. And for me, when I buy, the way I'm trading, the way MTP trades, if we look, it's not trying to day trade. We're trying to buy and then just forget about it for a year, right? Or more. So if I'm buying here and I'm not trying to trade a bear market rally. I'm not trying to catch the bottom. I'm trying to catch a new bull run happening. So there's a couple other things that I want to look at in terms of price. I want to go into commodities a little bit. Let's talk about actually crypto a little bit. Crypto has not done well recently, but Bitcoin has shown a lot of relative strength actually. I mentioned NASDAQ is down over 20% from all-time high. Bitcoin is down about 22% from all-time high. Considering the beta of Bitcoin, it's shown a lot of relative strength, and the fact that it's green this year is awesome. That said, I'm still not trading it under the 200 moving average. But it's something that could happen. It's a favorite asset, and I look for relative strength, especially things that declined less. So if Bitcoin gets back above, say, 95, it could be a buy there. Okay, I wanted to look at commodities a little bit. So one of the fears is that, oh my God, and one of the ideas we've been kicking around is, well, if there's high inflation, this could be the commodity bull run is going to come about. Commodities being the price of pork, the price of soybeans, the price of oil. And personally, that's my fear. And that's a lot of people's fear in general, because the price of commodity increase is a measure of inflation. I don't want a high inflation. I can preserve my capital by not being in the market right now. I didn't lose money during this crash. But if commodities go on a bull run, it becomes hard to protect your money, hard to hide. What happened in the 70s when there was a period of stagflation, which was slow growth or no growth, was, do we have the 70s on here? We don't. 70s is we had a major bull run in various commodities. Let's look at the orange juice rally in the late 70s. It went up 250%. So I'm just noting, I think it's very interesting that if you look at different commodity prices, they're actually tanking. So it's interesting to me, I don't have the answer on this, I'm just noting it. With the price of doing business increasing, you would think the cost of goods would be increasing, but we're seeing them go down. So far, orange juice down, cost of oil is way down. This is good for this is good for Americans and just regular people. We want cheap oil. We want cheap orange juice. We want cheap, let's look at other things. Soybeans, down. Prices down. Corn. Corn's in a little bull run. What else can we look at? Let's look at cattle. Well, we had a couple red days, but the price of cattle is just, continues. But this is where we have to get creative and think about not different assets, but different asset classes. Because on a day like today, the S&P 500, there was fewer than 10 stocks that went up, were green today. And that means over 400, almost 490 stocks were red. And a lot of them were down over 10%. So are we going to see a bull run in commodities? Will we see it in emerging markets? That's something I'm open to and willing to discuss. It's interesting to me. But if we're going to circle back to the question of, is now a good time to buy the dip? I'm just trading a simple system, and I will again note that that system is not buying the dip. It does buy dips, but it doesn't buy crashes. It just sits them out and it waits on the far side. It never gets the exact bottom. But if we look, it didn't trade during 2022. It saved a lot of capital and it saved a lot of time. Let's look at some other. It's definitely tempting. I don't think it's that bad. I don't think it would be that bad to be a buyer here, but the fundamental is there's going to be a lot of shock. I just think that I'm interested in waiting, me personally. Now, I'm going to talk about one of the reasons why, and this is the Buffett indicator. The Buffett indicator takes GDP, or takes the stock market and divides it by GDP with the idea that there should be some sort of correlation, and the stock market should be roughly equal to GDP, because GDP is a measure of gross domestic product, The stock market is the business that creates that gross domestic product. And if the Buffett indicator, if the stock market divided by GDP is less than 100%, it implies that it's underpriced and undervalued. If it's over 100%, it implies that it's overvalued. So where is the Buffett indicator? As of December 31, 2024, the ratio values are 211%, which is 2 standard deviations above the average, and it is had major bear markets from, this looks like a log chart. No, this is a log chart. Had major bear markets. So this is something to consider. This suggests price could come down by 50% just to be valued normally, historically. So I want to look at what a 50% decline would be. I want to know what the Buffett indicator looks like for I want to know what the Buffett indicator looks like in March, or just from today. But if we were to measure a 50% decline, where would that put us? That would put us back at the 2020 bear market low, or 2022, sorry. Which I'm not saying that it would happen, but if it did happen, if it took out this low, to me, I would be very interested in buying a recovery of the 2022 low, especially if like the other things line up. So I guess that would be a level that I'm looking at. Let's look at the S&P 500. What would a 50% decline look like? It would go below that. So I'm interested, but we have to wait for that. As of today, so um, so as of today, the Buffett indicator is 170%. So it's still significantly overvalued. It was significantly overvalued at 200%. Another one is FINRA margin debt. So I want to look at a couple other things. And I also want to look at gold commitment of traders. I think there's lag time on this, but margin debt tells you how much leverage there is in the stock market. We don't have the March reading yet. How? In February. I think it's super late. Yeah, it's not. So it fell from February to January. It's probably going to fall again. But you can see it just about made a new all-time high. Actually, it did, according to this one. And the last time it was at this level is when we had this major washout. It we need to see March's level, but it just tells you, even if people are afraid, they're still very long. Because this is not just regular long, this is long with leverage. These are the more vulnerable positions. And the last one I'm interested in looking at would be commitment of traders. I need to turn this one off. And this is only valuable for looking at gold. So we're going to look at gold futures and see. Yeah, it's starting to look a little bit better. So the red line is the positioning of hedge funds, and the blue line is the positioning of commercial like gold miners. And the idea is when hedge funds are really long and gold miners are really short, price tends to go down. When hedge funds are short or flat and and you have gold miners are long, it tends to mark bottoms. So just to point out like an extreme here, let's look at a vertical line. This was an extreme where we had a awesome rally from. This was an extreme where we had a huge rally from. the numbers kind of increase over time. Here's another potential bottom. And then we got a couple signals, decent signals actually, in before the all-time high breakout, right? Um, Now the numbers are bigger, but the pattern continues if we're to look back here. But at the same time, also we have the tops are marked by potential tops are marked by extremes. I want to let you guys know if you're trading right now or if you're watching this right now, if you want the MTP system and want to trade with us, we're doing a sale right now. We're going to raise the price by 50% on Monday. So just to let you guys know. Okay, I'm going to make this one red. So again, there's a link in bio. So if you look for extremes, they don't always track, but we're at an extreme level for gold and have been. And what I would want to see for a buy on gold would be these lines, this to happen. I'm not saying like this will happen eventually. I have no idea when it will happen. And price could go much higher first. So I'm not saying, I'm just saying there's another scenario like the past that's going to happen eventually. That's when I'm interested in buying, but like every market looks overvalued. So I'm just going to stay in cash and I'm investing my money in traveling and in cash flowing business. So hope you guys find that helpful. And if you want to trade with us on the inside, there's a link down below. Appreciate y'all. Much love. Talk to y'all soon. Peace.